Welcome back to the Daily Crypto Deep Dive. There's a question that keeps resurfacing in finance circles, in boardrooms, on podcasts, and in hedge fund meetings. If some of the most intelligent billionaires on the planet fundamentally disagree about Bitcoin, then who is wrong? Or are we looking at something more complex, a situation where equally intelligent people are optimizing for entirely different outcomes? Because this isn't retail investors arguing on social media. These are individuals who have built multi-billion-dollar empires. They have teams of economists, analysts, and strategists. They have access to institutional research, private data, policy discussions. And yet some of them are accumulating Bitcoin aggressively, while others dismiss it as speculation, mania, or even delusion. Jamie Dimon, the CEO of JP Morgan, has repeatedly criticized Bitcoin over the years. He has questioned its intrinsic value. He has referred to it as speculative. And yet, JP Morgan has built blockchain infrastructure, facilitates crypto access for clients, and operates within digital asset markets. That duality is not accidental. Dimon's public stance often reflects systemic caution. His job is not to speculate on asymmetric upside. His job is to protect one of the largest banking institutions in the world. From that perspective, volatility is not innovation. It is risk exposure. Then there is Peter Schiff, a longtime gold advocate and vocal Bitcoin critic. Schiff argues from a monetary history perspective. His thesis is rooted in centuries of economic precedent. Gold has survived empires, wars, currency collapses, and monetary resets. Bitcoin, in his view, is a digital experiment with no intrinsic value beyond collective belief. To Schiff, value must be anchored in physical scarcity and historical usage. In that framework, Bitcoin appears fragile. Now contrast that with the bullish camp. Michael Saylor, executive chairman of MicroStrategy, has converted his company's treasury into Bitcoin and positioned it as digital property. Saylor's argument is mathematical. Bitcoin has a fixed supply of 21 million. Fiat currencies expand. When you measure long-term monetary debasement, scarce assets absorb excess liquidity. His thesis is not emotional, it is structural. He sees Bitcoin as engineered scarcity in a world of expanding balance sheets. Stanley Druckenmiller, one of the most respected macro hedge fund managers in history, has described Bitcoin as a generational asset class. He does not approach it ideologically, he approaches it probabilistically. If younger generations adopt Bitcoin as digital gold, if institutional allocation increases even marginally, the upside asymmetry outweighs the downside risk. Even Elon Musk has treated Bitcoin as a form of strategic optionality. Tesla purchased Bitcoin, later reduced exposure, and continues to engage with digital assets. Musk does not approach Bitcoin as a monetary purist. He approaches it as a technological evolution, something that may play a role in future financial systems. So now we return to the central tension. How can people of such high intelligence arrive at opposing conclusions? The first answer is that intelligence does not eliminate uncertainty. It simply changes how uncertainty is processed. Bitcoin represents a novel asset class. It is not a company generating cash flow. It is not a government bond yielding interest. It is not a commodity with industrial use. It is a decentralized monetary network with algorithmic scarcity. That means its valuation framework is fundamentally different. If you try to value it like a stock, it fails. If you try to value it like gold, it partially fits. If you try to value it like a currency, it behaves differently. The disagreement begins at the level of classification. Some billionaires define value through intrinsic productivity. If an asset produces nothing, yields nothing, and relies purely on future buyers, it resembles speculation. That is the skeptic framework. Others define value through network adoption. The internet itself produced no intrinsic cash flow in its early days. Its value emerged from network effects. If Bitcoin becomes a global settlement layer or store of value, its scarcity alone may justify valuation. That is the bull framework. These frameworks are mutually exclusive in the short term, but not necessarily over decades. The second factor is time horizon. A banker managing trillions in deposits thinks in terms of regulatory cycles and systemic stability. A macro hedge fund manager thinks in terms of 5 to 10-year asymmetry. A gold advocate thinks in terms of centuries of monetary history. A tech entrepreneur thinks in terms of exponential adoption curves. If your time horizon is 300 years, Bitcoin's 15-year history is statistically insignificant. If your time horizon is 20 years, Bitcoin's adoption rate may look exponential. Neither perspective is inherently irrational. They are calibrated differently. The third factor is incentive structure. This is uncomfortable but important. If you run a global bank, decentralized money challenges aspects of your business model. If you manage a gold fund, Bitcoin competes directly with your asset thesis. If you run a technology company, digital assets may complement your worldview. If you operate a macro fund, volatility is opportunity. Beliefs are rarely formed in a vacuum. They often align with economic positioning. This does not mean critics are dishonest. It means incentives shape interpretation. High intelligence applied within different incentive environments yields different conclusions. The fourth factor is risk preference. Two individuals can agree on probabilities, yet choose different actions. Imagine a billionaire assesses Bitcoin with a 30% probability of becoming a dominant global store of value and a 70% probability of stagnation or decline. One investor may say 30% is too low and avoid it entirely. Another may say 30% is enormous for an asymmetric opportunity and allocate 5% of capital. The disagreement is not about intelligence. It is about utility functions. Some optimize for preservation, others optimize for optionality. The fifth factor is generational bias. Younger investors grew up digitally native. They are comfortable assigning value to code, networks, and online communities. Older generations grew up in physical monetary systems, gold, property, equities. When Druckenmiller speaks about younger people preferring Bitcoin to gold, he is acknowledging generational transfer of monetary preference. Schiff views that shift as speculative mania. Both are interpreting cultural change differently. Another crucial dimension is model uncertainty. Bitcoin has existed since 2009. Modern monetary systems have existed for centuries. When historical data is limited, models become unstable. High intelligence often means recognizing that uncertainty. Some respond by avoiding the asset entirely. Others respond by taking calculated exposure. It's similar to early internet investing. In the 1990s, brilliant investors dismissed internet stocks as bubbles. Others saw structural transformation. Many companies failed. A few reshaped the global economy. Bitcoin could follow either path. That ambiguity fuels disagreement. There is also the philosophical divide between centralized and decentralized trust. Traditional finance is built on institutional trust: banks, governments, regulatory frameworks. Bitcoin is built on cryptographic trust and distributed consensus. To someone who has built wealth inside centralized systems, decentralized money may appear unnecessary. To someone concerned about sovereign debt and currency debasement, decentralized scarcity may appear essential. Again, this is worldview, not intelligence. Another layer is career risk. If a banker publicly embraces Bitcoin and it collapses, reputational damage follows. If a macro investor allocates a small percentage and it fails, it becomes a footnote. The cost of being wrong differs across professions. High intelligence includes awareness of reputational asymmetry. We should also consider portfolio construction theory. Many billionaires are not making binary bets. They are diversifying across asset classes. Even critics sometimes hold indirect exposure through funds or corporate holdings. Some public skepticism may coexist with private hedging. That is not hypocrisy, it is risk management. Then there is the question of intrinsic value versus emergent value. Gold's intrinsic value is often debated. Its industrial use accounts for only a portion of its price. Much of gold's value derives from social consensus and monetary history. Bitcoin, critics argue, lacks that history. Bulls argue that digital scarcity in a globalized world may generate new forms of monetary consensus. If value emerges from collective agreement, then both gold and Bitcoin derive strength from belief systems. The difference is duration of belief. We also need to discuss volatility. Bitcoin's price swings are extreme. To a conservative wealth preserver, volatility is instability. To a growth-oriented investor, volatility is opportunity. The same price movement triggers different interpretations depending on mandate. Consider this. If Bitcoin fails, the downside for a diversified billionaire allocating 2 to 5% is manageable. If Bitcoin succeeds and becomes a global reserve asset, the upside is transformational. Some billionaires are simply calculating that asymmetry differently. There is also the macro environment. In eras of quantitative easing and expanding balance sheets, scarce assets tend to perform well. In tightening cycles, speculative assets struggle. Billionaires who built careers navigating inflation cycles may view Bitcoin through that lens. Some see it as digital gold during monetary expansion. Others see it as a liquidity-driven bubble, vulnerable to contraction. Another important element is technological conviction. Those who deeply understand cryptography, network security, and open-source protocols may assign higher confidence to Bitcoin's durability. Those rooted in traditional finance may prioritize regulatory power and state control, assuming governments can suppress or regulate it effectively. Which model proves correct depends on geopolitical trajectories. Let's also acknowledge ego and narrative. Financial elites often have strong public identities tied to specific philosophies. Schiff's brand is gold advocacy. Saylor's brand is Bitcoin maximalism. Dimon's brand is institutional stability. Public positions reinforce identity. Reversing them carries reputational cost. That doesn't invalidate their intelligence. It explains persistence of divergence. Now, is someone wrong? Possibly. But not necessarily in the way retail debates frame it. It may not be a question of right versus wrong. It may be a question of probability weighting under deep uncertainty. If Bitcoin becomes a globally recognized store of value alongside gold, bulls will appear visionary. If regulatory pressure intensifies and adoption plateaus, skeptics will appear prudent. High intelligence does not eliminate disagreement in probabilistic systems. It often sharpens it. History is filled with examples of brilliant individuals disagreeing before paradigm shifts. Railroads, electricity, the internet. Even central banking itself was controversial in its infancy. The deeper insight is this. When intelligent people disagree strongly, it often signals that the asset in question sits at a structural crossroads. It is not fully understood. It is not fully mature. It exists in a zone where future states diverge widely. Bitcoin occupies that zone. Some billionaires see it as a hedge against sovereign overreach and currency debasement. Others see it as a speculative asset lacking productive capacity. Some hold it as optional insurance. Others reject it on principle. The divergence is not proof of irrationality. It is evidence of incomplete information. And perhaps that is the real takeaway. Markets are not puzzles to be solved with a single correct answer. They are dynamic systems shaped by incentives, psychology, regulation, technology, and culture. The fact that billionaires disagree may not weaken Bitcoin's case. It may actually validate that it is a frontier asset, one that challenges established frameworks. Over time, data accumulates. Adoption metrics mature. Regulatory clarity improves. Volatility stabilizes, or it doesn't. Eventually, uncertainty compresses and consensus emerges. Until then, disagreement among the elite is not a flaw in the system. It is the system. Because in environments of radical innovation, intelligence does not converge. It competes, and the market decides. Make sure you are following the show, and as always, we will see you at the top.